Rare earth minerals, your smartphone, EV, even the F-35 fighter jet all rely on them. All the while, China spent 2025 tightening its grip on the supply. The opportunity is there, but everyone's chasing the same mining stocks, even though the data says they're not the best bets. In fact, our 115-factor quant model rates some of the biggest name stocks in the group as holds or even a sell. The real opportunities are not where most people are looking. And the best stocks here are not the obvious miners. All 5 stocks I'm about to share with you today are A-rated on our quantitative rating system based upon a stringent review across growth, value, momentum, financials, and sentiment factors. This includes a stock that has beaten earnings 10 straight quarters, and yet most investors still haven't caught on. So who the heck am I? Well, I'm Steve Reitmeister. I spent over a decade as editor-in-chief of Zacks.com, one of the largest investment research websites in the world, and now I'm a partner at WallStreetZen.com, where we have an array of tools to help everyday investors top the market. If you want to see more stock picking themes like this, please hit that like button now. Before we dive into the picks, let's quickly explain why rare earth metals are attracting so much attention lately. China controls about 70% of rare earth production. In 2025, they started using it as leverage. Export controls on key elements disrupted supply chains almost immediately, forcing Western automakers to cut output and even shutting down some plants. Washington responded fast, major investments, stockpiling, and billions flowing into domestic supply chains. But most investors stop at the obvious move, which is to buy the rare earth miners. The real opportunity is further downstream. The companies that turn these materials into products that enjoy a real pricing power, serious cash flow, and proven execution, meaning they are the much better investments. Every stock on the list today carries an A from our Zen Rating system, placing them in the top 5% of the 4,600 stocks we track. To be clear, they are in the top 5% for the health of their fundamentals like growth, value, sentiment, and financial strength. And I want you to stick around for the last one of these 5 picks because the execution track record behind it is unlike anything else on the list today. So first up, we have Allient Incorporated with the symbol ALNT. Now, most investors have never heard of the company. That's because they were formerly known as Allied Motion Technologies just a couple years back, and the business doesn't spend much time in the financial press. And most people don't see the attractive rare earth investing angle. So the company designs and manufactures precision motion components, brushless motors, servo drives, encoders, and motion controllers. The good news is that the defense contractors, aerospace manufacturers, and medical device companies have been quietly increasing their orders from Allient. We're talking about hardware built for environments where failure is not an option, and these are customers who don't switch suppliers over price. That customer base has been placing larger and larger orders with the company. Here's the rare earth connection. Every brushless motor Allient built with rare earth permanent magnets, the same material to the center of China's export controls. Now, the CEO has specifically called out defense and data center infrastructure as primary growth drivers, both of which tie directly to the rare earth supply chain reshoring. ALNT's earnings grew by a whopping 65% last year, and analysts are expecting another 35% growth in the year ahead. It may sound like a stretch till you appreciate they have beaten Wall Street earnings estimates for 6 straight quarters. This translates to a strong growth rating in our quant model, putting in the top 4% of all stocks. And at the same time, it ranks in the top 4% for safety, which is quite a rare combination. Allient ranks highly across the board, putting it in the top 1% of all stocks after considering all 115 fundamental factors. The risk is that shares have increased by over 160% since this time last year. They're going to have to keep executing at a very high level to keep that price aloft. One earnings stumble and it would be cut down to size quite quickly. Gladly, all current signs are suggesting that that will not be the case, including their string of 6 straight earnings beats. All in all, ALNT is a consistent outperformer, giving you a unique and potentially lucrative way to play the rare earth trade. If you're finding value in this kind of data-driven analysis, subscribe and hit the notification bell. We publish breakdowns like this 2 to 3 times a week, and the next video is one you don't want to miss. So turn back to our five rare earth stocks. This next one has us taking a step further up the supply chain. The standout trait for the stock is ROE. It has nearly doubled the industry average. We're talking about Constellium SE with a symbol of CSTM. As I just shared, the company generated a return on equity of almost 33%, as the industry is nearly half that at 18%. That advantage is a big reason that JP Morgan, Wells Fargo, Deutsche Bank, and BMO Capital are all maintaining bullish ratings right now. But almost nobody is talking about this stock in the context of the rare earth trade. Constellium manufactures high-performance aluminum products for aerospace and defense, materials engineered to tolerances that only a handful of producers worldwide can hit consistently. Think fighter jet airframes, armored vehicle structures, and satellite components. You might be thinking to yourself, hold on there, aluminum isn't a rare earth metal. And you're right. This is what we call a sympathy play. The Pentagon formally designated aluminum a critical defense material as part of the same policy push driving rare earth investment, and began prioritizing domestic and allied nation suppliers who meet Department of Defense qualification standards. Constellium is one of them. The same tailwind that's benefiting the rare earth companies is also benefiting them. ROE is not the only metric that is much better than industry average. Revenue is forecast to grow 50% faster than industry average, and return on capital employed clocks in at 14.5% versus the industry average of 10. The Zen Ratings appreciates what is so special about CSTM, given that it carries a coveted A rating. More specifically, the company ranks in the top 1% of all stocks we track for its fundamental prowess. Those previously noted Wall Street strong buy ratings put them in the top 10% when it comes to sentiment, what the smart money is doing. It's also in the top 8% for both growth and momentum. However, I do have to mention the risks. CSTM has European exposure in packaging and automotive markets that have been a bit soft. 2 consecutive strong beats heading into 2026 suggest some stabilization, but the full recovery isn't guaranteed. Constellium is the advanced materials layer of this group of 5 stocks, a company generating exceptional equity returns in a space the Pentagon is treating as strategically critical. That's a very attractive combination. The next pick is the one that will raise some eyebrows given everything that we said so far, because it's actually a minor. I know we said we're not going to be looking at minors, but let's just say there's an asterisk next to that claim. I'll show you why we're making an exception in a moment. Gladly, the data can make the case even better than I can. And by the way, if you want more top stock ideas like this, then claim your free copy of our special report, 3 Stocks to Double This Year. I'll drop the link in the description below or scan the QR code. Now we're moving on to Nexa Resources with a symbol of NEXA. Okay, so why is this the only minor on the list? This stock trades at less than 4 times forward earnings, and it also happens to be generating $634 million in operating cash flow annually. Those things don't usually go together, making this stock quite appealing. Nexa Resources produces copper, zinc, lead, and silver from established operations in Peru and Brazil. This is not a speculative story. This is already a steady producer generating real cash flow from minerals that are indispensable to the exact infrastructure the West is now scrambling to build. Copper is the backbone of every EV charging network, every defense electronic system, and every data center expansion being built right now. Silver goes into solar panels, satellite components, and missile guidance systems. As Western governments accelerate efforts to secure supply chains outside of China, then diversified producers like these in friendly jurisdictions become strategically significant. The stock carries an A rating overall, which means it's a strong buy. Plus, as we drill down to component grades, it also gets A grades for both value and growth. In both these categories, it ranks in the top 1% of all stocks. Now, our artificial intelligence rating, which uses a neural network trained on more than 2 decades of data, which identifies likely outperformers, that puts Nexa in the top 7% of stocks in our universe. Now, to top it all off, it's in the top 9% for sentiment. This is a measure of what the smart money thinks of the stock. For example, recently the analyst from Scotiabank set a price target for Nexa with an upside target, which is 40% higher than where it stands today. The real risk, and I'm just going to be blunt about it, Peru has a documented history of community protests that can force temporary mine suspensions. That might sound vague and abstract, but it's the type of political and operational risk that doesn't show up in the financials until it's too late. Next is the upstream layer of this group of stocks, a cash-generating miner at a valuation that suggests the market hasn't fully connected the dots yet on its real earnings and value potential. The next pick takes us back downstream, and it comes with one of the most compelling analyst calls on the entire list. I am talking about Astronics Corp with the symbol of ARTO. Now, forgive me for saying your name wrong, but Michael Ciamaroli of Truist Securities ranks in the top 1% of analysts on Wall Street for his stock picking performance. So, back in late February, Michael set a price target on Astronics that implies an upside of more than 55% in the year ahead. This is not the kind of upside you would expect for a company that makes electrical power systems and avionics for military and commercial aircraft. All of these systems require rare earth permanent magnets. Once again, these are the exact materials China has been restricting. Astronics builds the hardware that cannot function without them. This is actually a hot growth stock when you appreciate that earnings are expected to increase 210% year over year. That is not a typo. Right? To be clear, Astronics is recovering from a period of supply chain pressure that suppressed earnings while revenue kept building. The last two reported quarters both came in well above estimates, so a turnaround appears to have already begun. What does the fundamental review of the Zen Ratings say? Well, top 1% overall, top 1% for growth, plus it scores in the top 15% for both safety and financials. The trade-off is that Astronics carries only a C rating for value. It's trading at a high trailing PE of over 80, which should come down to size as the growth story unfolds. Note that the price to earnings growth ratio is a very low and reasonable 0.49. That makes things a touch more appealing on the value front. Astronics is the platform integration layer of the supply chain, the company converting rare earth materials into the actual systems that makes military aircraft function. Now, I told you from the start to stay around to the end because you want to hear about this last stock. We're talking about Moog Incorporated with a symbol of MOG.A. Okay? When a Tomahawk missile steers towards its target, Moog actuators are doing the steering. When a satellite adjusts its orientation in orbit, Moog control systems are executing that adjustment. And when an F-35 maneuvers at high G-forces, Moog flight control actuators make it possible. This may be the last stock on our list today, yet it sits at the very top of the defense technology supply chain. Those rare earth permanent magnets we already mentioned a couple times, they aren't a component in Moog's supply chain. They are the supply chain. Every actuator, every servo, every motion control system Moog ships depends on those rare earth minerals. The entire U.S. government effort to secure the rare earth materials exists in part precisely because companies like Moog need them so much. These systems are so mission critical. The defense prime contractors cannot substitute them. There is no adequate alternative. Now let's dive into the numbers. Revenue is up 21% year over year, which came in at a full year of $4.1 billion. And that helped translate into 47% earnings growth. And here's the key detail that had me do a double take the first time I looked at the stock. Moog has beaten Wall Street earnings estimates for 10 consecutive quarters, a pretty rare feat that says a lot about the quality of their management team. The most recent quarter came in at 19% above forecast. The quarter before that, 15% above. The quarter above that, 13%. That is called earnings momentum and is one of the most appealing features in finding a stock that is likely to outperform. Not surprisingly, our Zen Rating system gives this company a hearty A grade, which translates into a strong buy recommendation. On top of that, it scores a stellar A grade for growth and a solid B for safety. This is worth noting because growth and safety are often at opposite ends of the investing spectrum, where you have to trade off one for the other. Not in this case. But I want to be clear about the risk. Moog is not cheap. It gets a C for value because it's rallied by almost 70% in the past year. So why am I still highlighting this stock? Because they've outperformed consistently and outperformed significantly. That is a trait that usually continues in the future, pushing share prices even higher. Now, pulling back to the big picture, China still controls the vast majority of global rare earth production and refining. They've demonstrated they're willing to use this as leverage against the world economy. These are also cyclical industries tied to defense budgets and industrial demand. A global recession compresses margins across every company on this list just by varying degrees. And reshoring is a multi-year story that will take time to fully unfold. So, if you're looking for quick-hitting trades, probably isn't the stock list for you. However, if you're looking to build positions in quality companies sitting directly in the path of one of the most significant supply chain realignments in a generation, then these 5 stocks certainly fit the bill. Now, I'm curious, which of these 5 stocks is your favorite and why? Share your thoughts in the comments below for the benefit of our community. Plus, I read every one and appreciate your insight. And if you're interested in another hot growth trend, then I recently broke down what famed analyst Dan Ives had to say about the top players in the AI space. Check that out now.